watching Businessworld Live. I'm Danny Laurel.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day, Monday. The Philippines agrees to put an end to a 14-year trade dispute with Thailand.
Industry players expect another round of oil price hikes this week, and due to soaring fuel costs, power rates are also set to increase this month.
After ending in a bloodbath last week, the local bourse is seen to move sideways this week over lingering inflation worries.
And President Duterte leads the lowering of the tunnel boring machine that will be used to drill underground for the Metro Manila subway project. We begin our broadcast with some updates on the trade front, including the government's move to resolve issues with Thailand over taxes on cigarettes.
The signing of a bilateral agreement seeks to put an end to the 14-year trade dispute between the ASEAN neighbors. The World Trade Organization says the Philippines and Thailand signed an understanding on agreed procedures for the comprehensive settlement of their long-standing dispute. Back in 2008, the Philippines complained about Thailand's evaluations of cigarettes imported from the Philippines. In 2010, the WTO decided in favor of the Philippines, but Thailand had not complied with the ruling.
Now, separately, the DTI announced that the Philippines has forged an investment promotion and protection deal with the United Arab Emirates, which is expected to generate up to 7 billion pesos in investments and up to 2,500 jobs. Meanwhile, 3 newly signed agreements are seen to enhance business-to-business interaction between Israel and the Philippines. Israel is targeting more electronic imports from the country, as well as food, agriculture products, and garments.
The government slashed its debt payments for the 5th consecutive month in April. Data from the Treasury show that debt service fell by a third in April to almost 43 billion pesos due to a double-digit decline in amortization. The government also paid all of its April amortization to external creditors, marking zero principal payment for its domestic liabilities. This puts the next administration in a tight spot to complete the settlement scheduled for the year. This as the incoming administration has to issue over 940 billion pesos in the next 8 months to complete the debt service for the year. All right, and external factors still controlling the movement of the index last week saw another painful decline. What's the outlook now?
Well, just brace yourself for some more pain. Last week, we declined more than 3% week on week. We were the biggest drop in Asia, and we are extending, or that already extended, the quarter's loss to 9.4%, the sharpest 3-month decline we've seen since the first quarter in 2021. This coming week is likely rather to be even more choppy. Analysts say only bargain hunting may possibly lift the index, and you can see that already here, a clear sell-off. Mining and oil leading the downtrend. That's down by 2.8%. But really, every sector, every industry is in the red. Our composite down by 1.4%, 6,400 levels na tayo, Jess. And you know, I guess if there's any reprieve, the only thing we can say is that we are simply following what the rest of the region is looking like. This, of course, comes after on Friday, the U.S. for the month of May had the highest inflation in 40.5 years, mas mataas pa than what we have been seeing. Of course, all of the stocks are falling on the back of sapping sentiment. That's what they're calling it. And this decline, of course, is the worst drop in global shares since October of 2020. Now, here to tell us more about that, we have with us Luis Limlingan of Regina Capital. Luis, what is going on and why isn't this over yet? You know, especially, of course, people have priced in naman that high inflation over in the U.S. People know that the Fed is being aggressive here on rate hikes. Why is there so much surprise over last week?
Well, several things have, I guess, changed the position of a lot of fund managers. And when the inflationary report came out, it seemed that inflation wasn't peaking yet in the US. Perhaps maybe it should not come as a surprise because oil, after falling back to a little below 100, a couple of months ago, we see it back to $120. So now there's pressure on the central banks as to how they're going to respond to fight inflation. And second is, um, initially the concern was we're going to have high prices, so people are just going to cut back. But because this is going to be lingering, and it's going to, it's beyond the demand controls, meaning, this is caused externally. It's not by overconsumption, and then you can just scale down. It's because of the on the supply side, that because of the war, there's going to be a crunch. Now, I think before the thing was that inflation is going to be the main concern. Now it's moving to, or the talk is that it's going to be stagflation, meaning it's going to be lingering much longer, given that the prices still haven't adjusted, given that we've already experienced some rate hikes from the central banks, both locally and regionally, and that they're already hinting as to there might be more coming soon in the next few meetings.
Now, in the U.S., like you mentioned, the concern is stagflation. No? So it might be too aggressive and it might eat up growth. What about here domestically? Are we gunning? Like, should we have more aggressive rate hikes? Some are saying that there will be two more before the year ends to be preemptive for inflation. What do the markets want? More rate hikes to arrest the inflation, or less, or more accommodative policy? What's happening now?
Well, it's much worse in the U.S., or more pronounced, because twofold. Again, you have the you have the soaring prices of oil, and then I think on the labor front, we've been hearing about the Great Resignation. A lot of I guess the millennials or people in their midlife haven't been returning to the workforce, or they're looking for a lot of opportunities. In fact, I've been hearing anecdotes that if you want, for those who just to get an interview, they're already going to pay you, they're already increasing wages. So it's twofold, that they have to raise prices just to accommodate the wages, and then now they have to also think about oil. So that's what's driving the US, and that's why it's already above in the Philippines. Because traditionally, if you look at the data, usually we're around 3 to 4%, and the US is around 1 to 2%. And it's quite a shock that for the first time in 40 years, the US is around 8%. And not in recent history has it happened that our inflation is much more manageable, to say the least. So that's what I think is that's why I think there's a much bigger concern in the US as the Philippines. But again, unlike the US, 99% of our oil requirements are imported. So it's also going to hurt consumer spending in the medium term. At least for oil, at least in terms of the US and other. If you're a country that is heavily reliant on commodities, at least from a business perspective, you can invest in those companies. In the Philippines, I think it's still limited right now, even though if we're rich in minerals.
Okay.
So again, I think that's why you can see a lot of the sell-off happening.
What about the reopening of the economy, and how that, of course, the oil is a story that we have no control over, or very minimal control over. But theoretically, if we reopen the economy and we have more things going on, and the COVID situation is contained, hopefully, we don't know what's going to happen come July. But is this not enough to propel growth, to, of course, hopefully arrest or at least mitigate that impact of inflation on the consumer side from the oil prices?
Well, 5.5%, close to 6% is something, or even if you look back in recent history, we've actually experienced that. In fact, going back to around 2008, oil actually hit $150. So it's not new. Of course, it's uncomfortable to say the least, but that you did experience growth. But it cannot subsist for so long. At a certain point, there has to be a pass on to the consumer, right? I think now we're already seeing that happening. If it was just maybe 1 to 2 months, I think the merchants and the establishments were absorbing the cost. But now, I think if they can see that for the medium term that this is going to persist, then I think they're going to be forced to raise the prices. So it's going to have a domino effect.
Okay, Luis, which sectors or how to position here? Because right now, I mean, despite the rising commodity prices, you do see, I'll put out my launch pad, that the mining and oil counter has been the one most heavily hit. What is the reason for this? Why is that the counter? Shouldn't this be, for whatever strange reason, the bright spot that we've had, at least throughout the year to date?
Correct. Well, for one, you could see, for more obvious reasons, you could see that there was a rebound, probably even going back to late of last year. So I wouldn't be surprised that a lot of the people who invested in mining oil are just profit taking at the moment. Maybe they might be redeploying later on, but I think they're just taking money off the table since, you've seen these companies already, double or triple their prices, going back to the pandemic. So I think that's one front, and I think the second is basically, if you're a fund manager and you say exit the Philippines, you don't actually say or specify which sector. You just say you have to sell across the board. So they're just pulling out essentially, especially with a lot of net foreign selling happening over the last few days. When the fund pulls out, they don't pull out of a sector. They just pull out from the region specifically. So that's how they give the order.
Okay, and on that note, Luis, impact of the peso depreciating on the back of course, elevated oil prices on this net foreign or foreign fund exodus. Are you seeing more pain when it comes to the foreigners? How are they treating the Philippine stocks in their portfolios?
Again, that's the problem. Even though, I think what's happening to mining and oil, it's a bit of collateral damage. Yes, there might be some opportunity because, again, for obvious reasons, commodity prices are high, so they should still be doing well. But the problem is, if I'm a fund manager, I'm just going to be blunt. My position in the Philippines is usually very small. If it's around less than 5%, I'm not going to nitpick every sector and say, okay, I'm just going to keep it in mining oil. I'm just going to say, I'm going to take out my position the whole of the Philippines, maybe redeploy in a more obvious sector. Let's say OPEC plus countries, for example.
Okay.
I would be investing there. So I'll just pull out of the Philippines and be investing there. Because, again, they're looking at the risk profile of the country as a whole. And we can't blame them because even if we are the locals and we know probably the sector much better, even though it's going to perform well. But for them, they see that, well, Philippines, for one, they're importing basically all of their oil requirements. So all sectors are going to be affected, and that's their views. Again, it's going to be hard for them to nitpick. They're probably monitoring, if there are around 260 companies in our universe, these foreign funds are looking at thousands of companies across different continents.
Luis, last question before we let you go. How do you find a floor or a support level here? Is it already up for bargain hunting at these levels?
Well, the way I'm looking at it is just tracking the general inflation and the price of oil. We saw that when oil was hitting around 120 to 130, we did fall to around a little bit. I think we were at the 6.4 level, so already close to that.
Yeah.
But again, the problem is at 6.4, probably that's going to establish your range. Let's assume first that oil will probably stay at $120. Probably 6.4, maybe a little below, close to 6.3. You're going to have your range for then. But the problem is, which I think is going to get investors thinking, is will oil keep on increasing? Is it going to go back to 150? And probably they're not going to come in yet, and they think it's going to drop. If oil is going to drop, maybe closer to back to 100, then I think they'll start to return. And I guess in relation to that would be inflation. Is it going to be peaking? I think now they're looking at it could reach 6%, and then how aggressive is the central bank of the Philippines or the U.S. in response to this? So again, there are a lot of moving parts, and that's why the target keeps on changing. But I think for now, they're just looking at oil is at $120. So far, it hasn't moved. But who knows what's going to be happening throughout the week, and what are going to be the responsive of the each country's administration in regard to this.
Okay, ang sakit naman nun, 150 per barrel. We don't know what that chaos might happen. All right, but thank you so much for those insights. That was, of course, Luis Limlingan of Regina Capital.
The world is awaiting this week's U.S. Fed meeting as U.S. inflation hit a 40-year high. More of that and global stories courtesy of Bloomberg Week Ahead.
So let's take a look at the major events in your week ahead. Fed Chair Jerome Powell facing renewed pressure to dial up his hawkishness after the May CPI data all but dashed hopes of a peak in inflation. The Bank of England follows on Thursday, a 25 basis point hike expected there. Different story though in Japan, where the BOJ's dovish policy is under scrutiny as the yen tumbles to historic lows against the dollar. And ahead of all that, data from China likely to show activity picking up marginally after a tough April.
Ahead of all of those risks, of course, one thing is for certain, volatility is here to stay. Global stocks are already coming off their worst week since 2020, and 2-year Treasury yields surged to the highest in 14 years after that U.S. inflation report. Now, traders see a 50-50 chance of a 75 basis point Fed rate hike in July, while the likes of Barclays and Jefferies say that could come as early as Wednesday. Now, that has the bond market firmly pricing in a hard landing with the yield curve re-inverting. We'll be closely watching Chair Powell's post-meeting news conference on Wednesday, where policymakers' characterization of inflation and the dot plot will be absolutely critical. That is your week ahead.
Now pausing for a quick break, but coming right up after that. Another oil price hike is expected to take effect tomorrow.
We'll tell you the amount of the adjustments when Businessworld Live returns. Stay with us.
Baka hindi tayo naka-mute.
Why? And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Danny Laurel. Now, President Duterte has expressed gratitude to Japan for funding the construction of the Philippines' first subway system.
And the Metro Manila subway is expected to be completed in 5 years' time. Camille Samonte with the details.
President Duterte led the lowering of the tunnel boring machine for the Metro Manila subway project. This is the first underground rail system in the country. In his speech, Duterte thanked the Japanese government for funding the Metro Manila subway project through the Japan International Cooperation Agency.
I cannot seem to fathom the love of the Japanese people for this republic. Until now, Japan has continued to help us to the extent that yung ibang Davao City, the new highway and bridge and everything, it would seem really that we are a part of the Japanese government.
Japanese ambassador to the Philippines, Koshikawa Kazuhiko, said the project is a testament of the strong alliance between the Philippines and Japan.
And we feel more than honored to be a major part of the Philippine government in its bid to provide more comfortable and convenient life to as many Filipinos as possible through the infrastructure development.
The tunnel boring machine will be used to excavate the soil and construct up to 12 meters of tunnels. The machine will make the process of tunneling faster, while significantly reducing above-ground disruption during construction. The Metro Manila subway is a 33-kilometer underground rail line stretching from Valenzuela City to NAIA Terminal 3 in Pasay City. The subway will have 17 underground stations in some areas in Metro Manila. The project aims to cut the travel time between Quezon City and NAIA from over an hour to just 35 minutes. Once completed, the subway is expected to accommodate up to 370,000 passengers per day. The subway is expected to be completed by 2027. For News 5, Camille Samonte, We Are One News.
In other news, Meralco is raising its rates in June due to an increase in generation costs, and that is driven mainly by, of course, higher fuel costs. Now, the overall power rate will rise by almost 40% per kilowatt hour. This means that households consuming 200 kilowatt hours will see an 80 peso increase in their electricity bills and up to 199 peso increase for 500 kilowatt hours. This as the increased demand kept the spot market prices at elevated rates. Now, Meralco says this is still largely due to the high oil prices in the global market.
If world crude oil prices continue to go up, then we will see an impact on generation costs. In the case of Meralco, about 1/3 to 40% of our supply comes from power plants that use Malampayan natural gas, whose prices are affected by world crude oil prices.
And still on fuel prices, another round of oil price hike is set to be implemented tomorrow. Uni Oil projects that prices of diesel would increase by up to 4 pesos and 50 centavos per liter. Gasoline prices are likewise expected to rise by up to 1 peso and 60 centavos. Once these adjustments are applied, the price of gasoline will have increased by over 28 pesos per liter this year, while the price of diesel will be almost 39 pesos per liter higher since January. Another week, another round of increases. Is this the peak or should we expect more heat? Let's get insights from June Neri, Chief Economist over at BPI. June, good morning.
Morning, Jasper. Good morning to your viewers.
All right, another round of oil price hike this week. A number of commodities prices still rising here. Should we be expecting hotter inflation in the coming months after that May print? And when do you forecast things or levels to actually taper off?
Well, as long as the conflict in Eastern Europe continues, we will see a continuing increase in our own inflation rate here in the Philippines, not just in the US and Europe. So I guess it's good to be conservative for the government, given that the circumstances beyond our control are kind of challenging.
Mm-hmm. Now, when do you see levels at least tempering off? Do you see that still happening in the latter half of the year? That was at least the consensus earlier this year. Mm-hmm. But do you see that happening?
Well, it can peak as late as first quarter of next year, because we only started seeing the impact of the conflict in March and April through May. So coming from lower base in January, February of this year, we can still be seeing prints above 5% up to that point. So it will take a while before inflation goes back within target or maybe just a little over the target. In fact, there's no certainty whether we will be back on target next year.
Okay, wow, it's a bit of a gloomy outlook
Yeah,
there.
nga eh. Sir, we had Luis Rimlingan on the show saying that market expectations are anywhere between oil falling below 100 a barrel and oil going to 150 a barrel. Which side are you on? I mean, how are economists treating this? If we are status quo, unfortunately, in terms of this war, and even if they do end, it's going to take some time to unwind all of these issues. How are you seeing the oil prices? Nga? Have we not adjusted enough in terms of the situation to have at least a more predictable level of oil prices?
Well, we don't have to be at $120 or $130 per barrel for inflation to continue going up, just for the simple reason that our oil suppliers are only starting to purchase from abroad because they were able to draw down a good amount of their inventory this past few months from because of the very weak demand the last couple of years.
Got it.
So the passing on of the prices to the consumer will only start to be felt maybe in this quarter and next one.
Okay, sir.
As for the outlook, it's very hard to tell, Danny, if it's going to be 150 or 100. But even at 100, there's very little hope that we will be going back to 4% through early of next year.
Okay, June, I mean, of course, much of the action that's being done, at least on the monetary side, you have the BSP expected to raise rates again by another 25 bips this June. Cumulatively, how much do you see them hiking rates, and up to what level do you think can the economy absorb?
Well, they have been signaling that they will only be hiking 25 basis points at a time, which I think is a little bit dangerous because in the US, they're now talking about 350 basis point hikes from now until the end of the year, after the surprise May print came out higher than expected. Now, unless we want the peso to very quickly rise towards 54, 55, 56, and we don't keep up with the US Federal Reserve rate hikes, then so be it. Then that's the choice of the government. But if you want less spiraling between inflation and the currency, then there has to be some kind of aggressive rate adjustment on our part. We need to be lockstep with the US if we at least want to keep the differentials between our own interest rates and theirs close to parity.
How aggressive is aggressive here, June? I mean, in order for us to at least get out from what you call dangerous, possibly dangerous levels here of just increasing rates by 25 beeps at a time.
That's not going to squeeze the margins of the sector, sir.
Yes. So, for example, if there is now a possibility of a 75 basis point increase in the US following the surprise number in May last Friday, then we probably cannot afford a 25 basis point hike in this June 23 meeting of the BSP because we'll be so far behind the yields already. What will happen? People will migrate from peso assets to dollar assets. No? And that will even exert more pressure on the currency. So it's going to be a vicious cycle if we don't do it aggressive enough. So to me, 50 basis points should be the minimum on June 23. If the government decides to do otherwise, then it's a choice to make the peso weaker.
Okay. Sir, what can the government do at this point? Apart from monetary policy and rate hikes, we already see that the prices are being passed on to consumers. And of course, this will hamper growth and consumption. It's just going to be a vicious cycle. What can the government do at this point? Is there still a possibility to take out excise taxes from oil, give subsidies to the transport sector, give more subsidies to employment? What can be done?
Well, I guess we have no choice if prices of oil continue to go up and the peso continues to depreciate, then some of these subsidies will probably have to continue with the transport sector at least. The consumers, unfortunately, will have to bear the higher cost of global oil prices, and I'm not sure whether the incoming administration is willing to give up the excise taxes, considering that the debt metrics of the country are already deteriorating. So it's really being caught between the deep blue sea, and the devil in the deep blue sea. So very hard choices that they have to make. I guess monetary policy has to really be more determined, more less hesitant, I guess.
Okay, June, lastly, before we let you go, by how much do you see this making a dent on growth, especially in the second quarter? I mean, is a resumption of economic activity enough to actually offset these high levels of inflation?
Yeah, it's actually quite odd that, some analysts are only revising their growth rates for the Philippines upwards. Compared to us, we're actually revising it downwards. We originally thought it was going to grow at around 7.5% for this year, but because of this commodity price phenomenon arising from the conflict in Eastern Europe, we're actually revising it lower. So from about 7.5, we're only looking now at 6.5 to 7, because of the impact on consumption, on the currency, and overall demand. So the recovery is going to be somewhat muted as a result of these headwinds.
Okay, thank you for telling it as it is, caught between a rock and a hard place.
That's
what
it
came
is.
to mind. Thank you, BPI Chief Economist June Neri.
And that's a first look into the business day this Monday, June 13, 2022. Join us again tomorrow at exactly 9:30 a.m. You can also catch us on Signal Play. Register for a free account now at www.signalplay.com and stream One News Live anytime, anywhere. I'm Jess De Los Santos.
And I'm Danny Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.